Securing the right commercial space for your business involves more than just finding the perfect location. It requires careful financial planning and an understanding of the unique funding requirements for commercial tenancies. Unlike residential rentals, commercial spaces often demand significant upfront capital and have different financing rules that every business owner should understand before signing a lease or purchase agreement. For new businesses, the financial challenges begin with the reality that banks typically don't finance brand new ventures. Lenders usually want to see at least 12 months of profitable operations before considering a business loan. This means entrepreneurs must be prepared to cover all startup costs from other sources. You'll need sufficient cash reserves, not just for the first month's rent and security deposit, which often equals 3 to 6 months' rent, but also for necessary renovations to meet building codes, equipment purchases, professional fees, and ideally enough operating capital to cover 6 to 12 months of expenses until the business becomes profitable. Certain business types like restaurants, daycares, or auto repair shops face even greater upfront costs due to specialized build-out requirements and equipment needs. The financing landscape varies significantly depending on whether you're leasing space or purchasing an existing business with its location. When buying an established business, expect to need at least 75% of the purchase price in cash, as banks rarely finance more than 50% and never cover inventory. You'll also want additional reserves for several months' rent and operating expenses. Commercial property purchases require 25 to 50% down payments depending on the property type and your business financials. Land purchases are particularly capital-intensive, often requiring 50% down plus detailed development proposals. Franchise opportunities sometimes offer better financing options through the franchisor, though these still typically require 30 to 50% down payments. Smart tenants approach their commercial space strategy with realistic financial planning and multiple funding options in mind. Beyond traditional bank loans, consider alternatives like personal savings, home equity lines of credit, or investments from family and partners. Each option carries different requirements and risks that should be carefully evaluated against your business model. Most importantly, remember that commercial financing decisions focus heavily on your business's financial health and the property's income potential, rather than just personal credit scores. By understanding these requirements early, preparing thorough financial documentation, and exploring all available funding sources, you can secure the right space for your business while maintaining the financial flexibility needed for long-term success.